Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. This week, the Reserve Bank Board increased the official cash rate by another 50 basis points. That's the fourth month in a row that rates have increased as the Reserve Bank tries to bring inflation under control. In light of the central bank's decision, I wanted to get an understanding of how investors need to change their thinking in a rising interest rate environment. Donahue D'Souza is the head of investments at HSBC, and he says there are four things investors need to consider. Remember, this is general information only, and you should seek professional advice before making any investment decision. Don, welcome to Fear and Greed.
Good morning, Sean. Thank you for having me.
Have we forgotten how to invest in a rising interest rate environment? Because it's been a long, long time.
It certainly has, Sean. So as you mentioned, 4 rate rises in a row. Yesterday's rate rise of 50 basis points is the third consecutive 50-point move. It's certainly a challenging period for new investors. That is, those who've invested in the market recently, seeking higher returns and willing to take on more risk. This is new territory for them. Some investors may have anticipated the rate rises and may have been proactive in adjusting or rebalancing their exposure accordingly. And for some investors, certainly that first 50 basis point hike would have added a shock factor and it would have taken some time for that to sink in. But I think the reality is that interest rate rises aren't necessarily a negative for the share market. It's certainly designed to improve economic conditions and bring supply and demand back into equilibrium. Rate rises are occurring globally, not just locally, and that's what's contributed to some of that volatility in equity markets. And it's that volatility that's going to be a shock to those investors, especially after they've enjoyed such a good long bull run.
Okay, so before we get into sectors and important rules around investing, I just want to keep on this macro environment. You said interest rate rises aren't necessarily a negative for the market. Over the past 6 weeks or so, we've actually seen the market bounce. And indeed, July was a great month for many global markets, including the ASX 200. Why are rising interest rates good for equity markets, potentially?
I think the belief there is that it is good for the economy. It is going to bring back demand and bring supply and demand into equilibrium. I think the initial volatility in the market was the market trying to factor in a number of permutations and a number of variables. Firstly, how many rate rises, how fast the rates are going to increase, whether it's 25 or 50 basis points, what interest rates will be at the end of the year, which sectors are going to benefit from those rate rises, which sectors are going to suffer. So there's a lot of permutations, a lot of calculation, and that certainly exacerbates the volatility that we're seeing in. Once the market has done their calculations and once the Reserve Bank governor and his comments have been digested, and the markets have now got a steady line of where interest rates are going, the market tends to be a little bit more rational, and that's why you're starting to see some calm and potentially more rational markets.
Okay, so let's go into some of the sectors. Let's start with fixed income, which for the mum and dad investor is a less understood sector than equities, but there's things to like about fixed income bond markets at the moment.
Yeah, certainly. So when we talk about fixed interest and bond markets, the key thing to remember here is that bond prices have an inverse relationship with interest rates. That is, that as interest rates tend to rise, the prices of bonds tend to fall. And that obviously presents some opportunities there for investors to perhaps purchase some bonds at these discounted prices, receive a steady income stream or coupon payments over the life of that bond, but only if you're willing to hold the bond until its maturity. So the key consideration here for investors is the expiry date of the bond, also to a certain extent the issuer and credit rating, in tandem with obviously the investor's goals, personal situation, and most importantly, their investment time horizon.
Okay, so the fixed income market, the bond market, though, is more attractive. Well, it was even more attractive a few weeks back, but it's better now than it's been for a while, notwithstanding its prices have risen a little bit more recently. But otherwise, it is better than it has been for a few years.
Yes, it certainly has been. And that's because depending on what kind of investor you are and how you've adjusted your portfolio, generally the consensus is that the majority of investors, depending on their investment life cycle, have a nominal exposure to bonds. But as I mentioned, in this environment with the discounted bond prices, certainly those investors that have had a nominal bond exposure, and obviously that triggers some volatility in the equity markets, it's not uncommon for us to see a rebalancing and a reduction of exposure to equities and back towards bonds, maybe even some floating rate notes.
Stay with me, Don. We'll be back in a minute. I'm speaking to Donahue D'Souza, Head of Investments at HSBC. Okay, next, banks. How should we think about banks in a rising interest rate environment?
Well, the banks and the financial sector generally tend to benefit in a rising rate environment, and that's because rising interest rates tend to support the financial sector or the bank's underlying revenue and also their margins. That is, that the medium term lending rates tend to widen by more than the bank's short term funding costs. In addition, given the strong regulatory environment, which requires the banks to hold very strong capital positions, financial firms or the financial sector typically have robust balance sheets. And certainly, this combination is going to appeal to some investors where banks have traditionally provided some stable returns throughout periods of heightened volatility. But we'll get a better insight into how the banks fare in the reporting season. Certainly, we've been through a robust mortgage and housing boom. Investors will be watching very closely for any signs of deterioration in margins and also impairments.
Okay, there must be a lot of opportunities in the market at the moment, though, particularly where inflation and rate hikes are yet to hit sharply, or maybe they've hit very sharply already and kind of they're past the worst of it. Are there opportunities locally and indeed further afield into Asia and places?
Yeah, certainly. Particularly when you have a look at the global front, you've got US and Europe who are seeing inflation push towards 10%. We've now got local economic houses factoring in that Australia is going to push towards inflation rate of 8%. We're yet to see those same high levels of inflation translate to Asia. Certainly the global economic slowdown has started to affect inventory levels and impact company order books, and Asia will be no exception. If you're starting to look at it now, you can see Taiwan and South Korea, they're certainly starting to see lower demand for their technology products globally. Singapore at the moment remains challenged by high wages and their high exposure to the financial sector. And of course, China has a different set of variables, which are obviously well written about. And we're starting to see that translate to weaker consumer sentiment. But there are some valuations there, particularly some longer thematics, particularly if they're supported by government policies, the likes of infrastructure. So there's certainly some interesting sectors there.
Okay. Another concept, which I know you've spoken a bit about and how important it is, particularly now, is diversification. Can you explain?
Thank you, Sean. I hate to coin the old adage, but diversification. Don't put all of your eggs in one basket. Again, it's
John, you have just coined it. You know that.
yeah.
You say you hate to, but you just did.
I have to throw it in there. I know that investors are tired of hearing, but it holds true.
It's true.
And
Yeah.
it's very hard to pick the best performing sector in any one year. So if we have a look at 2021, it may have been global equities. In fact, it was global equities that was the best performing sector. And if you have a look at the year before in 2020, it was fixed interest or real estate investment trust. Now it's very hard to continually adjust your portfolio and try to predict the best performing sector. So by holding a diversified portfolio, you're effectively spreading your funds across different asset classes and you're more inclined to benefit. Now, one of the easiest ways to do that is obviously reduce single asset or investment exposure is by looking at an exchange traded fund or a passive fund. And that effectively gives you access or exposure to a basket of securities or an index. And they've been very popular with investors because of the ease of transaction, the innovation in those products. And in this period of time, it's not uncommon for investors to build an entire portfolio of ETFs, to build a global balanced portfolio just with ETFs. And where required, potentially purchase an additional ETF, for example, fixed interest or floating rate notes, if they're inclined to take advantage of that short-term flow of funds into bonds. That being said, it still comes down to the investment profile, the investor's risk tolerance, and the investment horizon.
Don, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Donahue D'Souza, Head of Investments at HSBC. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.